When it comes to diversification, one popular way is to gain exposure to indices and exchange-traded funds. They pack tens or even hundreds of equities under one roof, so it's no wonder they're go-tos for many option traders. Although the components of an index and its related index ETFs may be nearly identical, the same can't be said about the way their options trade. Let's explain. Remember that indices aren't a financial product a trader can buy or sell. Rather, they're a calculation of how a large basket of individual stocks collectively perform. So, index options allow traders to speculate on the movement of that basket. They allow their holder to gain exposure to the index for a defined period. Now, because indices only exist on paper, there's no actual trading of them happening. Index options are a European style, meaning there could be no way to exercise an index option before its expiration date. And there's no exchange of shares occurring either. Check out our next lesson on American and European options for more details on their differences. Just like other European options, index options are settled in cash. The settlement is based on either the opening or closing value of the index on the expiration date, depending on what's outlined in the contract. Some of the most popular index options include the SPX, which tracks the S&P 500 index, the RUT, which tracks the Russell 2000 index, and the VIX, which tracks the S&P 500 Volatility Index. While index options are a popular avenue for diversification, they tend to be relatively pricey. That's because many indexes themselves are quite expensive. For that reason, some retail investors might turn to ETF options, which tend to be significantly cheaper while providing similar exposure. There are many exchange-traded funds that aim to mirror the performance of an index, and traders can purchase options on them instead. For example, an option contract for the SPDR Trust ETF with the symbol SPY aims to replicate the S&P 500 index, costs roughly 10 times less than the index itself. Of course, there are also ETFs that track all sorts of unique equity baskets. The choices are almost endless. ETF options essentially function just like individual stock options. They are American-style contracts that involve swapping shares of the underlying ETF when exercised rather than a cash transfer. They can also be exercised or assigned on or before their expiration date, and they typically expire on the third Friday of the month for standard monthly contracts. Now, unlike indexes, some ETFs pay a dividend if they hold stocks that issue them. That's an important factor that can influence whether an options holder decides to exercise the contract. Another consideration is trading volume. ETF options tend to have a lower liquidity and wider bid-ask spreads than index options, which can make it a bit more challenging to get your orders filled at your desired price. So traders should be mindful before they act. Regardless of whether they're interested in index or ETF options, investors should always be aware of their minimum equity and margin requirements. These can both differ significantly between different types of options trades. This information can be found on TD's Margin Requirements website. With all of that said, you're ready to learn about how to put your newfound knowledge into action. Cue up our lesson, Placing an Options Trade in WebBroker.